When Jack Dorsey, the founder and CEO of Twitter and Square, told people he was moving to Africa for a few months in 2020, it raised some eyebrows in Silicon Valley. After all, tech companies have consistently looked to China and India when they talked about reaching vast, untapped populations who are slowly coming online and needing smartphones, cloud computing, and mobile payment infrastructure. But it turns out in 2020, that sounds a lot more like Africa rather than China or India.
On this month's episode of Next Africa,
Liberation Day.
Decades of U.S.-Africa trade ties are threatened as President Trump unleashes tariffs on the continent. The levies effectively end duty-free access to American markets for sub-Saharan Africa. We'll explore the impact as African countries seek new trading partners.
Is with the continent, and one of them is Japan. The East Asian country is enhancing its influence in Africa by initiating several economic and environmental projects. In its latest move, the Japanese government has announced plans to raise $1.5 billion for impact investment in Africa, with the goal of reducing greenhouse gas emissions and promoting sustainable growth on the continent.
Investors and mining firms gathered on Monday at Africa's biggest industry conference amid a newfound optimism that the uptick in commodity prices could show up investment after years of downturn. Over the last few months, iron, copper and tin prices have risen sharply and have rekindled the morale of a sector that had previously been in.
The Conference on Trade and Development states that between 2006 and 2011, Africa has the highest rate of return on inflow of foreign direct investment, 11.4%. This is compared to 9.1% in Asia, 8.9% in Latin America and the Caribbean. Ghana and the Netherlands renegotiate the
Earths, which are used in everything from our smartphones to EVs to fighter jets. It has significant reserves at home and access to supplies from overseas, thanks to major investment in foreign mining operations, particularly in Africa, which is rich in critical minerals and metals. Beijing has also built up a dominant position when it comes to processing global supplies. The U.S. has been working overtime to try and...
But a recession may never materialize if consumers keep spending.
I continue to think that it's possible that this time is really different. And the reason is there's just so much excess demand, really, in the labor market.
I mean, it's been amazing how resilient, in a way, the consumer has been to this inflationary shock.
The consumer is still very strong. They're just spending differently.
People are still spending, and that has been important.
Of a six-figure salary used to be the gold standard income.
Many entry-level job seekers find themselves in a catch-22. In order to get experience, you need a job. But in order to get that first job, you need experience.
Over a third of employers refrain from hiring recent Gen Z college graduates in favor of older employees.
If you're not happy here, then you can leave. As far as I'm concerned, if you hate our country, if you're not happy here, you can leave. If you're not happy in the U.S., if you're complaining all the time, very simply, you can leave. You can leave right now. Come back if you want. Don't come back. It's okay too. But if you're not happy, you can leave.
On this month's episode of Next Africa,
Liberation Day.
Decades of U.S.-Africa trade ties are threatened as President Trump unleashes tariffs on the continent. The levies effectively end duty-free access to American markets for sub-Saharan Africa. We'll explore the impact as African countries seek new trading partners.
The warning signs had been building for months, but Washington refused to believe them. Analysts had repeatedly reported that foreign investors were quietly redirecting their portfolios, moving capital away from American markets and toward emerging African powerhouses. What seemed at first like a minor realignment soon grew into a massive economic migration worth billions. The global financial architecture, long centered firmly around the United States, was shifting in ways that left Washington stunned, confused, and increasingly panicked. The turning point came when several major European, Asian, and Middle Eastern investment groups abruptly reallocated large portions of their funds into African infrastructure. Bonds, mineral development projects, manufacturing expansions, and renewable energy ventures. Investors who once treated Africa merely as an experimental frontier were now pouring resources into its financial systems with unprecedented confidence. The explanation was simple yet deeply destabilizing for the United States. Africa was no longer viewed as a high-risk environment. It had transformed into one of the most promising. stable, and future-oriented investment destinations in the world. And this transformation came at a time when the American economy was struggling with inflation, massive debt, rising unemployment, and declining global trust. Washington officials held emergency meetings to understand why capital flight from the U.S. was accelerating so rapidly. Every report pointed to the same pattern: African nations were achieving extraordinary progress in political stability, energy independence, agricultural modernization, mineral processing, and technology manufacturing. Countries that once depended heavily on Western financial institutions were now creating sovereign wealth frameworks, attracting foreign capital on their own terms, and forming alliances with Asian and Middle Eastern powers that bypassed American approval. Africa was stepping confidently into a new economic era built on domestic value creation rather than exporting raw materials and importing finished goods. Foreign investors saw opportunity where Washington saw loss of control. African nations were offering tax-friendly industrial zones, long-term profit guarantees, regulatory transparency, and aggressive investment incentives. Moreover, Africa was rapidly expanding its role in global logistics, hosting new ports, rail corridors, trade hubs, and manufacturing districts that rivaled those in Asia. Investors recognized that Africa was no longer waiting for validation from the West. It was designing its own destiny, and anyone who hesitated risked being left behind. Meanwhile, American markets suffered an invisible yet devastating consequence. As investment groups reduced their exposure to U.S. stocks and bonds, market confidence began to erode. Treasury reports indicated that long-term foreign investment into the United States had fallen sharply, creating growing gaps in funding for public services, infrastructure maintenance, and technology innovation. Major corporations headquartered in America faced stock declines as investors redirected funding to African companies that promised higher growth and lower operating costs. Manufacturing sectors in the U.S., already weakened by rising production expenses and supply chain disruptions, were hit hardest. The economic shock intensified when Africa announced a continent-wide investment protection framework. This framework guaranteed security for foreign investments, stable contracts, independent arbitration courts, and corruption-free financing channels. Investors saw it as a historic turning point. Washington saw it as a direct threat to its global financial influence. For decades, the United States had relied on being the safest, most reliable destination for global capital. Now, Africa was offering an alternative free from the political polarization, currency volatility, and bureaucratic gridlock gripping the American economy. As foreign capital migrated toward Africa, the narrative in global media shifted dramatically. Economic journals published headlines declaring Africa the new epicenter of global growth. Analysts predicted that several African economies would surpass traditional Western powers within the next 2 decades. Investors who once specialized in American assets began learning about African regulatory laws, exploring African bond markets, and analyzing African venture capital opportunities. Washington watched this transformation unfold with disbelief. American policymakers tried reassuring the world that the U.S. remained the strongest economy, but their statements failed to inspire confidence. Investors saw the rising national debt, shrinking industrial base, political infighting, and inability to pass meaningful economic reforms. They also saw Africa rising with economic coalitions, cross-border energy grids, continental manufacturing agreements, and new digital currencies that allowed trade outside the dollar-dominated system. Investors understood a truth Washington did not want to acknowledge. Africa was the future. The panic in Washington escalated when African nations launched a unified investment exchange, allowing global investors to buy and sell African securities without routing through American or European intermediaries. This bypass fundamentally threatened the United States' long-standing influence over global capital flows. For decades, the U.S. benefited immensely from controlling international finance channels, transaction systems, and global currency settlements. Now, Africa had created its own gateway, efficient, modern, and fully independent. This development signaled more than economic competition. It signaled a geopolitical power shift. Foreign governments and multinational companies began signing decade-long investment commitments with African states, covering energy exploration, automobile assembly, pharmaceuticals, aerospace components, and digital technology. Africa was becoming a global manufacturing hub, and investors saw that entering its markets early would secure long-term dominance. Meanwhile, in America, manufacturing plants were closing, and innovation centers were losing funding as investors redirected capital to African research labs and technology parks. The most painful blow to Washington came from its long-standing allies. Countries that had historically aligned with the United States in trade and finance began openly favoring African partnerships. Middle Eastern sovereign funds, European technology groups, and Asian logistics companies announced billions in new African deals while reducing exposure to American counterparts. Western corporations abandoned U.S. expansion plans and shifted their factories, headquarters, and development hubs to African cities that offered lower taxes, cheaper labor, and easier access to emerging markets. This mass exodus of industries triggered job losses, declining productivity, and increased economic pressure across the United States. What truly terrified Washington was the realization that this shift was not temporary. Africa was not experiencing a moment, it was entering a new era. Investors were not merely reacting to American weaknesses. They were responding to Africa's strengths. They saw a continent with the resources to fuel the next century of global development and the ambition to shape its own destiny. They saw governments committed to industrial policy, technology transfer, and global partnerships that did not revolve around Western approval. Washington finally understood the depth of the crisis. The world was no longer looking to the United States as the center of global opportunity. It was looking to Africa. The panic that swept through Washington after the massive investment shift toward Africa did not fade with time. It intensified as the situation unfolded. Global financial institutions began publishing detailed reports on why foreign investors were fleeing American markets while eagerly embracing African opportunities. These reports shook Washington even more because they revealed something deeper than capital flight. They showed a fundamental collapse of global trust in the American economic model. Financial agencies noted that Africa was offering what investors wanted: rapid returns, young labor forces, stable long-term policies, resource security, and partnerships without political drama. Meanwhile, the United States was struggling under the weight of volatile markets, unstable interest rates, and endless political battles that made long-term planning nearly impossible. Investors were tired of uncertainty, and Africa offered clarity. They were tired of slow-growth economies, and Africa offered expansion. They were tired of nations consumed with internal division, and Africa offered cooperation. While Washington tried dismissing Africa's rise as a temporary trend, global markets thought differently. African nations were announcing new rail corridors linking mineral-rich regions to industrial cities, new energy grids connecting solar farms to manufacturing zones, and new shipping routes bypassing traditional Western-controlled maritime areas. The continent was integrating itself economically with an efficiency that stunned even long-term Africa observers. This continental reorganization made Africa more attractive than ever to investors who were determined to be part of the next major global economic boom. One of the most significant developments was Africa's collective move to process its own resources. Instead of exporting raw minerals like cobalt, lithium, copper, manganese, and iron ore, African nations began building processing plants, refining centers, and technology manufacturing districts. Investors realized that the continent no longer wished to be the world's supplier of raw materials. It wanted to become the supplier of finished, high-value products. This shift alone caught Washington off guard because it challenged decades of American control over global supply chains. The transformation became even more dramatic when Africa launched continent-wide value-add requirements for foreign investments. Any investor wanting access to Africa's minerals had to help build factories, research labs, and training centers on African soil. The old system in which the raw materials left Africa and the profits went to Western corporations was ending. Investors from Asia, the Middle East, and Latin America rushed to comply, while many American corporations hesitated, still expecting Africa to operate by its old rules. Their hesitation cost them dearly, as African governments awarded contracts to more flexible partners willing to support African industrialization. Washington's panic deepened when African stock exchanges surged. As foreign capital poured into African markets, share prices of local companies soared. Technology startups, renewable energy firms, agricultural innovators, and logistics companies all saw explosive growth. American investors who had ignored Africa for years suddenly found themselves priced out of sectors they once believed had little value. Meanwhile, American firms watched their own stocks decline as confidence eroded in the country's long-term economic stability. African nations took advantage of this momentum by forming investment clusters, regions where countries pooled resources to build shared industrial districts, research hubs, and digital innovation zones. Investors were attracted to these clusters because they reduced risk and increased coordination. Instead of dealing with one country at a time, they could invest in a region-wide ecosystem designed for growth. Washington realized this was a severe threat because American economic strategy relied heavily on dividing markets and keeping regions dependent on U.S. support. A unified Africa made this old model impossible. Another shock came when Africa and several Asian economic blocs launched a joint financial settlement system independent of the dollar. This development struck at the heart of American global power. For decades, Washington had relied on the world's dependence on the dollar to maintain influence if countries needed dollars for trade. The United States could shape global financial rules, but now Africa and its partners were proving that global trade could flourish outside the American-led system. Investors saw this as a once-in-a-generation opportunity to escape the constraints of dollar-denominated markets, and they embraced African currencies and digital payment systems eagerly. Inside the United States, economists warned that losing global financial dominance could lead to a long-term decline in national strength. Without foreign investors buying American bonds and funding U.S. government operations, borrowing costs would rise sharply. Inflation would get worse. Trade deficits would become unsustainable. Yet Washington struggled to respond in any meaningful way because the shift toward Africa was not driven by politics or ideology, it was driven by economic logic. Investors went where the future was, and the future was no longer centered in America. Meanwhile, African nations were not slowing down. They announced major expansions in aerospace manufacturing, shipbuilding, information technology, and electric vehicle production. International corporations partnering with Africa began relocating factory lines from European and American cities to African industrial corridors where labor was skilled, affordable, and plentiful. These relocations created thousands of jobs across the continent and reduced production costs for global companies for the United States. However, it meant factory closures, rising unemployment, and declining competitiveness. In an attempt to regain influence, Washington tried offering a new set of investment incentives to attract foreign capital back. But investors were not convinced. They saw American markets as oversaturated, burdened by high costs, and restricted by political uncertainty. Africa, on the other hand, offered fresh ground for expansion. With fewer barriers, investors trusted Africa's long-term economic trajectory more than America's short-term promises. The most painful realization for Washington was how quickly this shift occurred. The United States had spent decades positioning itself as the global center of finance, technology, and innovation. Yet within a few years of Africa's economic transformation, foreign investors had reoriented their focus almost completely. Reports revealed that nearly half of the investment funds once directed toward America were now flowing into African infrastructure, agriculture, mining, logistics, digital services, and renewable energy. Africa's strategic partnerships amplified this shift. Cooperation with Asia boosted industrial capacity. Collaboration with the Middle East expanded energy investments. Agreements with Latin America strengthened agricultural trade. Even European investors, despite Washington's frustration, were quietly increasing their African portfolios. Because the potential returns far outmatched American opportunities. By the time Washington fully understood the magnitude of the crisis, it was too late. The shift was not temporary and not reversible. Investors had found a new global engine for growth, and that engine was Africa. Programs that once attracted capital to the United States no longer carried weight because Africa offered something America could not: future potential, untapped markets, and limitless room for expansion. Washington officials spent countless hours debating how to respond, but the answer was simple and devastating. The world had discovered something powerful: that Africa was no longer waiting for permission to rise. Investors saw a continent determined to build, innovate, and lead. And in choosing Africa, they had begun rewriting the global economic map in ways the United States could no longer control. The shift of global capital toward Africa did not slow. It accelerated with a force few in Washington had anticipated. What began as a gradual diversification strategy adopted by Asian, Middle Eastern, and South American economies turned into an unstoppable wave of investment that rewrote the global financial map. Africa, once seen by Western analysts as a high-risk environment, was now regarded as the world's most promising investment frontier, absorbing billions that previously flowed into the United States. This redirection of capital sent tremors across American financial institutions, which realized that the continent's growth trajectory was no temporary surge but a structural realignment driven by geopolitical necessity and economic foresight. As more countries poured funds into African manufacturing, energy, agriculture, digital infrastructure, and mineral processing, the continent transformed from a resource supplier into a value-adding powerhouse. African nations negotiated vigorously, insisting that investments include technology transfers, local hiring requirements, and revenue-sharing agreements that favored long-term national development. What stunned policymakers in Washington was not merely the speed of the transformation but the unity displayed by African governments. The continent was no longer a passive recipient of foreign capital. It had become an assertive partner shaping the terms of global commerce. The real shock came when a coalition of African nations announced a continent-wide industrial policy designed to reduce dependence on Western imports. This initiative prioritized intra-African trade, renewable energy grids, regional manufacturing hubs, and shared technology corridors. Countries in Asia, Eastern Europe, and the Middle East supported the policy, offering financing at low interest rates and entering joint ventures that guaranteed mutual benefits. Each deal that Africa finalized represented not only new growth for the continent, but also a direct loss of influence for Washington, whose institutions had long dominated development financing across the global south. American corporations felt the blow first. For decades, they had relied on African markets as reliable consumers of processed foods, pharmaceuticals, machinery, and technology. But as African countries strengthened their manufacturing capacity, the demand for American imports plummeted. Domestic factories in countries across Africa began producing goods that once came from the United States, often at a fraction of the cost. Even more troubling for Washington was that African products started entering markets in Asia and Latin America, competing directly with American exports. It was a symbolic reversal. Africa was no longer the market. It was becoming the supplier. Washington attempted to counter the trend through diplomatic pressure, loan restructuring offers, and attempts at reviving old alliances, but none of these efforts achieved meaningful results. African leaders had grown wary of conditional aid, political strings, and decades-long promises that never materialized into real development. Instead, they saw undeniable benefits from emerging partnerships that respected their sovereignty and accelerated their economic ascent. Attempts by the United States to warn African governments about debt traps and strategic risks only strengthened the perception that Washington feared losing its global dominance rather than genuinely caring about African progress. The breaking point arrived when a consortium of African states partnered with several Asian and Middle Eastern investors to establish a unified commodities exchange. The exchange prioritized pricing African minerals, agricultural goods, and energy resources in a basket of global currencies rather than the US dollar. Washington viewed this as a direct assault on its financial supremacy. For decades, dollar dominance had given the United States unparalleled leverage in global trade, sanctions enforcement, and monetary stability. The fact that some of the world's largest producers of gold, cobalt, oil, and natural gas were now bypassing the dollar shook American analysts to the core. In financial circles across New York and Washington, alarm bells rang as investors watched commodities once exclusively traded on Western platforms begin to shift to the new African-backed exchange. American banks faced capital outflows, and hedge funds scrambled to recalibrate their global exposure. Meanwhile, African currencies strengthened, driven by increased trade, investment inflows, and regionally coordinated monetary reforms. What terrified Washington most was not the immediate economic repercussions but the precedent. Africa was proving that alternative systems could work without Western oversight. The political consequences came swiftly. Several African governments that had previously relied on U.S. military or diplomatic backing began reorienting their defense partnerships toward Eurasian and Middle Eastern powers. Joint military drills, technology exchanges, and surveillance infrastructure deals signaled a broader strategic shift. Washington interpreted this as a growing encirclement, a geopolitical reality in which Africa was no longer within the sphere of Western influence. Western media outlets began declaring that the United States was losing Africa, a phrase that echoed across think tank discussions and congressional hearings inside the United States. The investment drought triggered job losses, manufacturing contractions, and declining competitiveness. American companies that had offshored production to maintain cost advantages realized too late that Africa was becoming the new global manufacturing hub, one that welcomed foreign factories only if they aligned with local development goals. U.S. corporations struggled to regain market share, hampered by rising labor costs at home and increasing difficulty accessing African markets that now prioritized partners who contributed to industrial growth rather than extraction-only models. Washington-esque confusion turned to frustration when African nations unveiled a bold initiative to integrate electric vehicle supply chains across the continent. With some of the world's largest reserves of lithium, cobalt, manganese, and nickel, Africa established joint ventures with Asian and European manufacturers that enabled full-scale EV production, batteries, components, and assembly plants. This move directly threatened the U.S. automotive sector, which relied heavily on imported minerals and foreign battery technologies. As African-made electric vehicles entered global markets, the United States faced declining competitiveness in an industry it once dominated. Meanwhile, global investors who had long prioritized the stability of U.S. Treasury bonds began reassessing their portfolios. Africa's infrastructure bonds, backed by real assets and high growth potential, attracted sovereign funds, pension investors, and private equity groups. This shift undermined Washington's ability to use internal borrowing as a mechanism for global economic leadership. American economists warned that if the trend continued, the cost of borrowing for the United States would rise, reducing its fiscal flexibility and weakening its geopolitical influence. All these developments combined to create a sense of panic inside Washington. What officials had dismissed as temporary shifts had evolved into a comprehensive global realignment, one in which Africa was not merely a recipient of investment but a central driver of economic transformation. The United States faced a future in which its dominance in trade, finance, technology, and diplomacy was under threat from a continent it had underestimated for decades. The most unsettling realization in Washington was that the shift was irreversible. Africa was no longer waiting for Western approval, assistance, or partnership on Western terms. The continent had discovered its own power, using its resources, population, and strategic geography to reshape global economics. And the world had responded, turning Africa into the next epicenter of growth while leaving the United States struggling to reclaim influence it had once taken for granted.